Okay, financial market. So these are financial, it's a part of the financial sector which deals with flow of debt and equity capital. Okay, so this is a part of the financial sector which facilitates the flow of debt and equity capital. So when I say that it facilitates the flow of debts and equity. Let's say there is a person X and there is a person Y. Person X has money, person Y wants money for whatever purpose. Let's say Y is the farmer, he needs money for buying seeds, or he is a retailer who wants money for inventory, or he is a manufacturer, he needs money for raw material. And then there is X who has money. Okay, so they can approach a financial market and borrow money, okay, or get money by selling his shares. So that is what is financial market. So it facilitates the flow of debt and equity capital in the market. Okay, so what is debt? It acknowledges borrowing. What is equity? It acknowledges ownership. Let's say I am a company and I need money. So I can go to the financial market and I can get money through two ways. One, I can borrow the money. And second, I can share the ownership, or I can sell the part of the ownership. Let's say my company is worth 10 crore. Let's say my company is worth 10 crore. Okay. So 10% of that company is how much? 1 crore. So I can say I am going to offer you 10% of my company if you give me 1 crore. You understood? If I give you 10% of my company, give me 1 crore. That is equity capital. You all understood? So that is giving you the ownership. I don't want to give ownership, let's say. Then I will go and ask you loan. That is your debt instrument. So I will issue a bond. Okay, I will issue a bond worth 1 crore. I will issue a bond worth 1 crore. Okay, and I will borrow money from you with a maturity of, let's say, 5 years. So after 5 years, I will return back that money with interest. Did you understand? So that is your debt instrument. So whatever is the requirement of the investor and borrower, okay, time, duration, etc., there are different instruments involved in the financial market. There are different institutions that are involved in the financial market. There are different regulators involved in the financial markets. Is that understood? Okay, so broadly, the Indian financial market can be classified into money market and capital market. So the money market deals with instruments with a maturity of less than 1 year. Okay, with less than 1 year. So money market instruments or money market deals with instruments which have maturity of less than 1 year. Meaning what? Meaning if you need money for a period of less than 1 year, matlab you are going to repay it back within 1 year, such an market is called as money market. Now I have money to spare for 6 months. After 6 months, I need that money. Okay, so I will go and park that money where? Money market. I need money immediately for only 6 months. Let's say I'm a farmer. Okay, I need money for 6 months. Let's say I need seed now, fertilizer now. I will pay it back after 6 months when I get harvest. I'm growing rice. I can harvest it within 6 months. So once I harvest it after 6 months, I will give you back the money. So I need money only for 6 months. I'm a manufacturer. I need raw material. I will produce and export within 6 months. I'm a retailer. I need inventory to stock my shop. Within 6 months, I will sell them out and I will repay you back. So where all these people will go to for short-term money, they will go to money markets. Did you understand? They will go to money market. The people who have money that they need to invest for long term, or those who need money for a long term. Now, government is building a highway, or an industrialist is building an industry which is going to take 2-3 years. They would require long-term money. They will go to capital market. So, money market is for short term. It is mainly for working or running the business So that's why it's called as working capital. It's also called as working capital because the money that is used, okay, or taken from here is used for running the business. Alva, see, farmer, if he wants to buy land, it's for long term. So he will go to capital market. If he just needs it for a short term for running his operation, he will go to money market. Is that understood? See, for example, I will need money on the beginning of this month to pay salary to my staff. At the end of the month, students will pay fees and I can get that money back. So to run the business on a day-to-day basis, we need a working capital. So for that working capital, we go to money market. Same thing with government also. So government will have to pay salary regularly, but it gets income tax once every year, right? So for 9 months, 8 months, there is shortage of money to run the government. So what will the government do? Borrow for short term. Where will it go? And issue a money market instrument. If the government wants to build a highway, it's going to take 5-10 years. Okay, where will it go? So as simple as that. So this is what is the two segments, money market and capital market. Money market is for day-to-day running of the business, hence called as the working capital market. Is that okay? So your money market is regulated by RBI. Your capital market, especially the equity market, is regulated by SEBI. See, in money market, there is only debt instrument. What is debt instrument? Instrument which acknowledges borrowings. In capital market, there is both debt and equity. Also, this you should keep in mind. So, in this particular chapter, you are supposed to remember that the market is of two types, money market and capital market. There are regulators. Who are the regulators? Your RBI and SEBI. Then there are various markets. There are various instruments, money market instrument and capital market instruments. This we have to understand. So there is treasury bill, there is commercial paper, okay, there is your commercial bill, etc. All these are money market instruments. Then you have your capital market instruments. Is that okay? Then you have capital market and money market. In that you have primary market and secondary market. When the instrument is issued for the first time, it is primary market. When already issued security is traded, it is called as secondary market. Now let me give you an example. You all might have read today's newspaper, LIC. LIC is issuing new shares. So where is it issuing it? That issuing is done in primary market. Let's say you're lucky and you get LIC shares. You apply for it and you get it. So then you do trading. You sell it to me. I sell it to her. She sells it to him. So where is that happening? Secondary market. Is that okay? In both of these cases, there is primary and secondary market. When the instrument is issued for the first time to the public, or to the bank or anybody. It is happening in the primary market. When already issued security is traded, okay, that is happening in the second. So your share markets, what is happening in share markets? You are buying and selling already issued shares. So share market is a secondary market. All of you understood this? And then you have financial intermediaries. Who are these financial intermediaries? Because people might not know how to go and invest in these products. So you will go to a broker, share brokers, etc. They are your financial stock brokers you might have heard. So they are that. It can be online, it can be banks. Today banks also facilitate your share investments, etc. You can open a demat account in your bank. So they are all your financial intermediaries. So this picture, if you see, this is what you are supposed to understand in financial market of India. So there are regulators, there are instruments, there are markets, and there are intermediaries. These are the four pillars of your financial market.